I have spent my life observing markets, reading the patterns of human behavior, and tracing the wisdom of those who understood them best. Few understood it as clearly as Benjamin Graham, and among his many lessons, one stands out in both its simplicity and its power: the story of Mr. Market. Imagine a friend who comes to your door every day offering to sell you his shares in a business or to buy yours. Some days he is cheerful, confident, even euphoric, convinced that every investment is worth far more than it really is. Other days he is despondent, fearful, certain that disaster is imminent and that no price is safe. His moods swing wildly, often without reason or warning. This, Graham tells us, is the market, a creature of emotion, not logic. But here is the secret: you are not compelled to agree with him. You can listen, observe, and decide for yourself. You can buy when he undervalues a business, sell when he overvalues it, or simply walk away when he offers no opportunity at all. Mr. Market is not your master. He is your advisor, your mirror, your test of patience and judgment. In the next 20 minutes, we will explore who Mr. Market really is, why Graham created this allegory, and how understanding his moods can transform the way we invest today. We will journey through the Roaring Twenties, the crash of 1929, and the Great Depression, and see how these lessons applied to modern markets, from tech bubbles to volatile swings in global stocks. But to truly understand Mr. Market, we must first understand the man who gave him life: Benjamin Graham, the father of value investing and the master of turning market madness into opportunity. Benjamin Graham was born in 1894 in London, England, and moved to New York City as a child after the early death of his father. Growing up, he witnessed the fragility of fortune firsthand, a lesson that would quietly shape his cautious and analytical approach to investing. Even as a young man, Graham displayed a remarkable curiosity about numbers, business, and the flow of money. He devoured books on finance, history, and human behavior, seeking patterns in how people made decisions with money. It was not just about profits. It was about understanding risk, judgment, and human nature. When he began his career on Wall Street in the 19-teens and 1920s, Graham observed a world of speculation, enthusiasm, and frequent folly. Markets surged with optimism, then crashed with panic. What fascinated him was the behavior of investors themselves, the irrational swings of emotion, the herd mentality, the greed and fear that could drive prices far from reality. These observations became the foundation for Mr. Market. Graham recognized that the market is less a rational machine and more a reflection of human moods. Prices fluctuate not only due to earnings or assets, but because of collective psychology. Some investors are swept up in the euphoria, others paralyzed by fear, and most fail to see the opportunity in the chaos. And so, the allegorical Mr. Market was born, a daily reminder that the market's moods are unpredictable, but that a disciplined, rational investor can learn to profit from them. But Graham's lessons were about to be tested in the most dramatic way. The Roaring Twenties and the crash of 1929 would reveal both the peril and the power of Mr. Market's moods. The 1920s were a decade of exuberance. Stock prices soared, optimism was everywhere, and the streets of Wall Street were alive with excitement. Investors dreamed of instant fortunes, swept up in a frenzy that seemed unstoppable. But beneath the surface, Graham saw the patterns of human emotion at work: greed driving prices higher, speculation replacing reason, and the market losing touch with reality.
As the decade progressed, the bubbles grew. Everyone seemed to believe that the good times would never end. Yet Graham remained cautious. He analyzed companies, studied balance sheets, and asked the fundamental questions. What is this business truly worth? What are the risks? And how much room do I have for error? Then, in October 1929, the bubble burst. Prices collapsed, billions of dollars vanished, and panic swept the market. Investors who had followed the crowd lost everything. Some were ruined overnight. It was in these moments of chaos that Graham's lessons became clear. The market, as he would later personify as Mr. Market, was not a rational guide. It was a mirror of human emotion, swinging between hope and despair. The wise investor does not follow Mr. Market blindly. Instead, they observe, remain disciplined, and recognize opportunity where others see only fear or euphoria. From this crucible of panic and loss, the allegory of Mr. Market emerged, a tool to help investors understand that the market's mood swings are not commands, but signals. And with this understanding, we can learn to act wisely rather than react emotionally. But what does it mean to truly interact with Mr. Market? That is what we will explore next. Benjamin Graham introduced Mr. Market as an allegorical friend, a character who arrives at your door every day offering to buy or sell shares in a business. On some days he is euphoric, convinced that the company is worth far more than it really is. On other days he is despondent, certain that disaster is on the corner. His mood swings are unpredictable, often irrational, and sometimes extreme. The genius of the allegory lies in the lesson it teaches. Mr. Market is there to serve you, not to guide you. You do not have to follow his advice or agree with his valuations. You may take advantage of his moods, ignore him entirely, or even politely decline his offers. The key is to remain rational, patient, and disciplined while observing the opportunities he presents. During Graham's lifetime, this approach protected investors from panic selling during the Depression and helped them recognize bargains that others ignored. Today, it applies just as well to volatile markets, whether it's a tech bubble, cryptocurrency swings, or sudden corrections in global stocks. The essential takeaway? The market's daily offers, no matter how urgent or enticing, are not commands. They are invitations. And a thoughtful investor must decide when to act, when to wait, and when to simply watch Mr. Market swing between hope and despair. But understanding Mr. Market is only part of the story. To use him to your advantage, you must first grasp the distinction between an investor and a speculator. Benjamin Graham drew a clear line between the investor and the speculator, a distinction that is as relevant today as it was in his time. An investor seeks to preserve capital and earn reasonable returns. They make decisions based on careful analysis, intrinsic value, and the margin of safety. They do not chase every headline, rumor, or hot tip, because they understand that the market, or Mr. Market, can be wildly emotional and unreliable. A speculator, by contrast, reacts to the market's moods. They buy when prices soar and sell when fear takes hold, often driven by emotion rather than reason. They are the ones Mr. Market most delights in tempting, always ready to take his advice, whether he is euphoric or despondent. During the Roaring '20s, the distinction was stark. Speculators were swept into frenzies, buying overpriced stocks, confident that prices would continue rising. When the 1929 crash came, many were ruined. Investors who followed Graham's disciplined approach, on the other hand, survived, bought undervalued companies, and saw their capital protected and eventually grow through the Depression.
Today, the lesson remains the same. Social media, news cycles, and hype can make markets feel like they are screaming at us to act. But an investor listens, observes, and waits for reasoned opportunities. Speculators act on emotion. Understanding which role you're playing and consciously choosing to be the investor allows you to use Mr. Market's moods to your advantage rather than be victimized by them. And yet, recognizing the distinction is not enough. To truly navigate Mr. Market's swings, one must understand the psychology behind his moods. Mr. Market's moods are driven not by logic, but by human psychology. Fear and greed dominate his decisions, causing prices to swing far above or below a company's true value. In Graham's time, this was clear during the 1929 crash and the slow recovery of the 1930s. Today, the patterns are strikingly similar. Social media hype, news cycles, and investor sentiment can make markets behave irrationally in the short term. As investors, our challenge is to remain calm when others panic and patient when others chase euphoria. Mr. Market's fear can be our opportunity, and his greed can be our warning. The key is to see beyond his emotions and focus on fundamentals, the intrinsic value of the businesses we own or consider buying. Graham understood that most investors fall into the trap of being swept along by the crowd. They buy overpriced stocks during frenzies and sell undervalued ones in panic. The disciplined investor, however, treats Mr. Market as a guide rather than a commander, using his swings as opportunities rather than reacting impulsively. The psychological insight is simple, yet profound. The market is a reflection of collective emotion, not always reason, and by maintaining a rational mindset, we can navigate these swings to our advantage. And understanding this psychology sets the stage for the most important question. How do we actually use Mr. Market to grow and protect our wealth? That is what we explore next. Once we understand that Mr. Market's moods are driven by emotion rather than logic, the question becomes clear. How do we profit from his swings? The answer lies in discipline, analysis, and patience. Graham taught that when Mr. Market offers shares at a price below their intrinsic value, we should consider buying. When he overvalues them, we might sell or simply wait. Acting according to reason rather than emotion turns market volatility into opportunity. During the Depression, Graham's investors purchased undervalued companies ignored by panicked speculators. They didn't gamble on trends. They analyzed balance sheets, earnings, and assets, ensuring there was a sufficient margin of safety to protect their capital. This combination of rational analysis and patience allowed them to thrive while others suffered. In modern markets, the lesson is just as relevant. When a stock plunges due to fear or when an entire sector is temporarily out of favor, the rational investor sees a potential bargain. Conversely, during speculative manias, when prices soar beyond reason, the wise investor does not succumb to greed. The secret is simple. Mr. Market is offering a daily invitation, sometimes generous, sometimes irrational, but it is always up to us to decide whether to accept. The disciplined investor uses these moods to their advantage, buying low, selling high, and always respecting the margin of safety. But even the most disciplined investor must be aware of some counterintuitive truths about Mr. Market. Even for the most disciplined investors, Mr. Market can teach lessons that are surprisingly counterintuitive. One of Graham's key insights was that doing nothing is often the best action.
While Mr. Market rages with fear or greed, the rational investor sometimes benefits most from patience, waiting for clear opportunities rather than reacting impulsively. Another lesson is cheap is not always safe, and expensive is not always doomed. A stock may appear undervalued, yet hidden risks, poor management, unsustainable debt, or declining markets can make it dangerous. Conversely, a high-priced stock may be justified by strong fundamentals and growth prospects. The margin of safety is what protects us, not the price tag alone.
Graham also warned that emotions are the enemy of sound investing. Fear leads to panic selling. Greed leads to speculative buying. By observing Mr. Market swings, but not following them blindly, we turn emotional chaos into opportunity. Even today, these lessons apply. Market bubbles, social media hype, and global news cycles can create irrational swings. The investor who respects Graham's counterintuitive truths can see beyond the panic and the euphoria, finding value where others see only risk. And yet, Graham's understanding of Mr. Market was also shaped by key turning points in his career. Benjamin Graham's philosophy of Mr. Market did not emerge fully formed. It was shaped through experiences, crises, and careful reflection. 3 turning points in particular reveal how his understanding deepened over time. The first was the 1929 crash. Witnessing the devastation of panicked investors taught Graham that markets are not rational. Prices swing on emotion, not reason, and fortunes can vanish overnight. The lesson was clear. The market is unpredictable, but disciplined analysis and a sufficient margin of safety provide protection. The second turning point was the publication of Security Analysis in 1934, co-authored with David Dodd. Here, Graham formalized his methods for evaluating securities, emphasizing intrinsic value, risk assessment, and the importance of using market fluctuations as opportunities rather than threats. Mr. Market became not just a metaphor, but a practical guide for applying these principles. The third came with The Intelligent Investor in 1949, where Graham distilled his ideas for a wider audience. He explained how different types of investors, defensive and enterprising, could use Mr. Market's moods to their advantage. The key takeaway, whether cautious or bold, every investor benefits from understanding that the market's daily offers are opportunities to be judged, not commands to be followed. These turning points show that Graham's wisdom was forged in reality, tested under pressure, and refined through experience. They also reveal a profound truth. Investing is as much about understanding human nature as it is about numbers. And with that understanding, we arrive at the final lessons for today's investors. As we conclude our journey with Benjamin Graham and his allegorical friend, Mr. Market, the lessons become clear. Investing wisely is not about chasing every price swing, nor is it about reacting to every mood the market exhibits. It is about understanding, patience, and discipline. Mr. Market is a daily reminder that prices are often driven by emotion, not reason. He will be euphoric one day and despondent the next. The investor who thrives observes these moods but does not obey them blindly. Instead, they use Mr. Market swings as opportunities, buying when prices are irrationally low, selling when prices are irrationally high, or simply waiting when there is no advantage. Key takeaways: observe, don't obey. Treat Mr. Market as an advisor, not a master. Focus on intrinsic value. Understand what a company is truly worth before acting. Respect the margin of safety. Protect your capital against errors, misjudgments, and market swings. Patience is power. Sometimes the best action is to wait. Discipline trumps emotion.
Fear and greed are ever present. Reason and analysis are your shield. By internalizing these lessons, investors today can navigate volatility, resist speculation, and build wealth steadily over time. Graham's wisdom is timeless. The market is not an enemy, it is a friend, whose moods, if understood and respected, can guide you toward intelligent decisions. In the end, Mr. Market is there not to frighten or entice. He is there to teach us about value, patience, and the enduring power of rational thought. By learning to interact wisely with his moods, we honor Benjamin Graham's legacy and protect not only our wealth, but our peace of mind.